Hello and welcome back. Today I want to make you a different presentation. So, right now it's not about the charts, but it's about calculating your risk and thinking through how to go into the gold trading. For this, I put here some price lines and I created um, an Excel calculator, and we will go through a few examples so that you understand signals are not everything. They are just little part of a small part of what you need to be a successful trader. Let's go through a few examples. You see here the lines, for example, but only hypothetically because this never happens. If you would have said here the price goes up, then you would have made an entry at this point and exit at this point. But as I said, this is so hypothetically, it doesn't happen. Um, you would have then made 153 pips, and for an exposure of 10,000 or zero 0.1, it's the same. You would have made, my account is in euro, so I think in euro, I'm in the euro area, 130 euros win. But what really happens really often, I would have said in this point, I was right with my thinking, with my strategy, so I want to strengthen it. So I buy again. I buy at 3338.02, and I also move my exit target. I say, for example, I look how the chart developed, and I say, for example, I want to put my target at 3351.16. So for both positions, I put the same exit. Okay, take profit. In this case, it's the same. And then, okay, I copy this cells up, and if everything would have went right, then I would have made this number of pips. But I can check with this Excel at every time, every moment I can check where I am. Let's say I go now to 33. At this point, I am at 3343.79. Remember, when the charts are moving, you don't know when they will stop. You don't know exactly. This is why we use take profits and stop losses. So entering here at this point, here we would have had maximum profit, but then it goes down. Let's say I didn't stop here, so I am in this point right now. I am at 3338.68. 1 second. Okay, I have to put this one. You see how my profit decreased here? So what can I do in this point? In this point, either you stop both positions and you gain actually almost the same as if you wouldn't have strengthened with the second position, or if you still let it open and it reaches this point in 3327.4, then you would have made a loss. And because of the second position you took, it could have been a major loss, you see here. So the loss came from the belief the trade is good and you took another long position here. If you would have put small take profit targets, it could have still been a win. But if you hadn't put profit targets, it would have turned into a loss, starting from around here. Without the second strengthening position, you see your loss would have been small. You could have put target stop loss 0. This is my favorite approach. When you enter a trade, you put take profit. Stop loss, not yet. Stop loss, you put it later. For example, you can put it when you're around here and you want to put the stop loss here. Like this, you would still make a profit even if the price doesn't develop further. Also, if you don't want to make any losses and you have only one position open, you can put the stop loss at the entry point and then you don't lose anything. This is my favorite approach. What gets complicated is when you strengthen positions. This can happen here everywhere. For example, here. If we take the next example here, at the point 3345.35, and I put the exit point, target point 3357.17. Okay. And I say I have only one position, so for now I clear this contents. Okay, let's say I got in here. I see the price is moving up, but short time it moves down. To see how much I would have in this point, I just check it here. Okay, so entering a 0.1 lot or 10,000 exposure, entering here, at this point you would have a loss of 106 points or 90.78 euros. Why is this important? Because at the point you enter trade, you should also know the possibilities. For example, if you enter here, you should be aware that the price can go also down to here and then rebound. It actually happens very often. And you need to have this margin. This means you need to have this margin from 3345.35 to 3327.40. point. It's comma. Okay, this means your account should be covered for this movement. If you cannot cover the possibility, you better don't enter the trade. Okay, let's see. It happens. It happened like here, and you see the trade gets up again around here, 3347.28, and you put the same exit position, take profit position. In this case, it doesn't go down again in this picture. But let's say from here it would go down here again to this point. Then you would have a pip loss double. So around 200 doubles. So this is very tricky when you think you're in a good trade to say I open another position because I am right. No, it's better not to do it because any moment it the price could swing up or down. In this case, this didn't happen and it didn't go down again. And if we look around here, 3351.16, then here, because the price moved upward slowly, both positions are winning. And of course, when I reach my target here of 3357, then both are winning trades, winning 184. But here I wanted to show you how easy it is to make losses, even if your initial idea was right. When you try to help your trade with signals, it's very important when you get these signals because, for example, a buying signal could have been issued around here. You see it when it's around here. You see it half an hour later. Then it's maybe too late. So signals should be used fast. If not, it's better that you watch your own charts and you decide for yourself when is the best time to enter. It could also be that the buy signal was issued around here and you see this signal when the price is here. Then, of course, it's better for you. But even if you see it here, you have to take into account that a certain volatility is always there. The same is true for selling. If we take the same example, let's say sell signal was issued here, then you have to decide, of course, for yourself what is better. You could have sold here and took some gains around here or stopped at zero here a few hours later. This is one example, and I wanted to show you also another example. I put all these marks only to go through these examples with you. Another upward movement, let's say here. It could have been you saw a steady upward movement here at around 8 o'clock or before 8 o'clock European time, and you would have said, I think it would go up. So I delete this again. Oh, no, not delete, clear contents. So entering this point would have been a profitable trade till here, but then you would have needed margin. Let's see how much you would have needed here. So in this point, if we take the minimum, 3274.51, you would have needed 170 pips as margin. And how much could you have been making that day? That day, let's say I put take profit at 3308.01. It could have been 141. But you see, you needed this margin in order to make profit or even to stop at break even. This kind of moves are normal. You see here a steady move upward. The inclination, the angle is around 45%. It could have been going up steadily, but now you needed margin. Even worse, if you would have said in this point, no, or in this point, from now on, it should go up like this, and you would have entered a second position at this point, lower than the first entry point. Okay, let's say exit the same. Then, of course, you would have made a bigger profit if the price developed in the preferred direction. But in this point, for example, 3278.08, the first trade would have still been a loss, and the second trade would have started to show some gains. Here, of course, the price developed in the desired direction, upward movement. But what I wanted to show you with these examples is how important it is to calculate your margin, your coverage needed before entering a trade. This data I have put in Excel is usually shown by all the providers you want to work with, but they only show you real-time exposure, real-time wins and or losses. But in order to take the appropriate decisions for your account and to decide what exposure you can manage based on your account size, based on your risk appetite, I think it's better to calculate in advance. And also, when you trust your trade and want to strengthen it, you need to look at alternative possibilities. How much can this go down before it recovers and goes up? In this case, okay, I said we entered here the price. Let's say the price would have dropped to here to 3249.01. 0.06. Then you would have needed a lot of margin. It could have been possible, like everything is possible in the markets, or could have gone to here. So if you don't want to make losses, you need to go in the correct direction. Best not to strengthen a correct direction, but have enough margin. Especially for this pair, for gold, you need a lot of margin because it can move very, very fast. It has a lot of volatility. You can make a lot of money, but also lose a lot of money. So margin management, I would say, for this pair is very important. That's why I wanted to make this video to show you some examples, because this, in my opinion, you need to calculate every day before entering a trade. And I hope you only have winning trades. Thanks for watching. Bye.